For those who are willing to put in the time, effort, and do the work, there's a lot of opportunity coming. Just don't have the expectation that's going to be like 2018, 2019, or 2020, where basically if you had the guts to buy almost anything, you made a lot of money.
What's up, everybody? Mason McDonald and Dan Haberkost here with another great episode of the Big Picture Blueprint. And it's always fun when we get to do this. So eventually we'll stop saying it's fun that we get to do this, that we got to interview someone that Dan and I have both been listening to for years now. But before we jump into the show, Dan, how are you doing?
I'm good, man. It's a beautiful day, and we got to interview a fellow outdoor enthusiast today, which would be Andrew Cushman. So he was a former chemical engineer and found real estate in 2007. So he's been in it a long time, left his corporate position to start a business, and started with flipping single-family homes in Southern California. And from there, in 2011, he transitioned to multifamily, so great timing there. He's successfully syndicated and repositioned over 2,800 multifamily units, is a frequent guest and panelist on a lot of the podcasts we listen to. And outside the business world, like I said, he's a big backcountry skier. He surfs. So we had a little fun talking about that as well. But this is a great episode for tactical advice from someone who's been in the business for almost 20 years. So I'm excited. Let's get to it. All right. Andrew Cushman, welcome to the show. How's it going?
It's going really, really well. I'm glad to be here. Thanks for the invite.
Absolutely. Yeah, we're excited to have you. Mason and I have both heard you on podcasts for years and years, so it's always fun to actually get to talk for about an hour here. So before we dive into the multifamily market today, I couldn't help but ask, I'm reading your bio. You're a certified alpine ski instructor. You like to surf. I'm very much the same way. I live in Encinitas, California. I used to live in Colorado, and I actually learned to snowboard at Loveland Pass in the backcountry during the pandemic. So when you take your tours, or when you give your tours, do you recommend starting in the backcountry, or do you have your people start on bunny hills?
Absolutely not. I actually gave up the formal instruction a few years back just because I got to the point where all I want to do is be in the backcountry and not at the resort. So, but yeah, if you're getting going, and even if you're actually pretty good skier, snowboarder, don't go into the backcountry without getting some education and training, in particular around how to not get buried in an avalanche. So,
yep, excellent advice. Do you have any favorite backcountry spots or mountains?
I do. The Sierra Nevada range of California is my favorite. And then after that, the Ruby Mountains in Northeast Nevada, which a lot of people are like, where? Basically think of the insanely popular Wasatch Mountains of Utah, but out in the middle of Nevada with no people. So it's great.
Oh, well, I'm going to have to look that up.
See, I'm a little baby. I like, staying on the blues and blacks at Breckenridge and waiting in line, and for hours on ski lifts to make it to après ski. But Dan, don't give advice to anyone. He hikes 14ers and then snowboards down them, so we don't trust Dan with advice, and no one should listen to any advice we give on this show about anything. But Andrew, with that being said, you've syndicated and repositioned over 2,800 multifamily units. You've been in the space for well over a decade now. We're recording this episode March 18th of 2025. In the past month, maybe, there has been a huge sell-off of stocks. The stock market has kind of been tumbling down, with a lot of that in the tech sector. Do you feel like, with your, call it notoriety or infamy, in the multifamily space and having access to a lot of, credit by being on all these podcasts, do you feel like investors are flooding into alternative investments right now, or what is the general sentiment of multifamily investors?
And when you say flooding into alternative investments, do you mean are you talking about like real estate syndication, that kind of thing?
Yeah, I'd consider real estate alternative. Yeah,
it's definitely not a flood. In fact, if you listen, most operators, if you listen to even some of the very well established ones, they'll say that raising equity now is much harder than it's been in the recent past. And of course, anyone who just got started within the last 10 years, what they got used to was not normal. when money was like, all you had to do is put up a post that, hey, I just quit my IT job and now I'm a syndicator, and people would just throw money at you. That wasn't a normal environment. And while I would say nowadays it's maybe a little harder than normal, it's actually, this is kind of how it should be, where people are approaching, equity investors are definitely approaching it with a little bit more caution, maybe smaller amounts, being a little bit more selective with the operators they choose, the deals they choose. With that said, it's, Warren Buffett gets quoted almost ad nauseum, but the reason is because it's true, and that's, buy when others are fearful and sell when others are greedy. And people are fearful right now. And just like in 2008, 9, 10, 11, and 12, or, especially in 11 and 12 is when we started, we were scooping up properties, for less than 10,000 a unit in some cases. And you couldn't get financing, you couldn't get equity. Everyone was terrified. And then we ended up selling those things for 4, 5, 6 times what we paid for them. We're not at that extreme of a point now, but it's somewhat similar, where it feels like we're kind of multifamily anyway, is bumping along the bottom of the current cycle and very likely to start an upcycle in the near future, maybe late 2025, definitely into 2026. So I wouldn't say equity is flooding in, but a lot of the smart equity is getting active, and that's why you see these headlines about, Blackstone and KKR and all these giant institutions doing $10 billion deals at a time. They're acquiring everything they can right now as they look ahead to the future and ignore the noise of, oh, geez, the stock market's down 8% and there's a tariff and gold broke 3,000. And, it's kind of important to watch all that, but real estate's a long game. And so when you're doing 5, 7 years out, be aware of the noise, but don't act on it.
I think that's a great answer. And I think you hit on a point that I wanted to bring up of, it does feel like there's a lot of fear and a lot of pessimism in the market right now. And you're positioned, you're not like the high end, the institutional people that are doing the $10 billion deals, but you're not the mom and pop person looking for their first 2-unit or 4-unit. What do you feel like you and your team are looking at and analyzing with deals that maybe some of the other sponsors at your level are, who don't have as much experience as you, might be overlooking?
Daniel, that's a interesting question. To quote a friend of mine, multifamily is an unfair game, meaning the longer you're in it, the more advantages you have over everyone else. So part of why we've still been able to do a couple deals recently is because we've been present in the same markets for, almost a decade and a half now. And so some properties, some opportunities come directly to us, and just, no one else gets to see them. And of course, there's deals that go to other people that we don't get to see too. It's not just us. There's been I'll give one example though to directly answer the question, is there's been a flight to, I would call, quality the last several years in multifamily, meaning everyone's like, okay, you know what? I just want the shiny, clean, beautiful looking class A- to A property, and, super low risk and all that. And there's good reason for that. However, as we start to come out of the bottom of the cycle and the distress works its way through, there's actually some really good opportunities starting to show up in that kind of, not class D. No one admits that a class D is a class D, right? And class D is crack house, violence, bring a gun if you're showing up to collect rent, right? I think one time in my entire life, thousands of properties, I actually saw a broker say, yeah, this is class D. It's always, well, yeah, it's a C, yeah. So I'm not talking the true class D stuff. I'm talking about, 1960s, 70s product, class C, which is kind of your workforce housing, probably, paycheck to paycheck, probably will never buy a house, that kind of thing. But in good markets with rising incomes, rising population growth, but those properties are getting into distress because many of them were bought in the last 5, 6, 7 years by owner operators or syndicators that don't know how to operate in difficult markets like we have now. Couple that with the challenges of floating rate debt and those loans coming due, you have properties that are suffering significant distress, but not because they're bad properties in bad areas. It's because basically of ownership issues. They structured the debt wrong and they don't have the experience to operate. And those are currently starting to present some really good opportunities to get into properties at a good low basis. Do the hard work to physically renovate it, get it reoccupied, get the occupancy up, get that net operating income up, and that'll create a lot of value over the next couple of years. Those opportunities are starting coming back. I think a lot of people are just like scared off of that, and rightfully so. But that's an opportunity that's coming back that I think a lot of people are missing. I think there's a lot more like mistakes being made on the other side of the coin of people still being too aggressive with certain assumptions. But in terms of opportunity that people might be overlooking, I think that's actually one of them is as a whole, the industry's gotten a little too focused on the really nice stuff. Again, there's good reasons for that, but being counter trend usually has its benefits.
Yeah, absolutely. That's it's funny to hear because not funny, but it makes sense because for a while there, I mean, during the frenzy that was late 2020, 2021 into 2022, at least the beginning of it, a lot of those 70s, 60s, 70s Class C apartments were trading at cap rates not that far off from some of the newer, Class B, A sort of stuff. And so then there was a big pull away from that. And so that leaves an opportunity, especially I would imagine your basis you're getting in on these plus rehab costs, you're probably getting in below replacement value quite a bit.
Yeah. And Dan, you just said exactly what the next thing I was going to add. And that was one of the most important reason to get away from Class C for the last 5 years is because the spread in cap rates between Class C and Class A narrowed to almost nothing. And basically what that means in layman's terms is Class C carries a lot more risk generally than Class A. And therefore, typically in a normal market, you get it trades at a higher cap rate, which means you're getting paid more for taking on that higher risk. Well, what happened in the last market cycle is it got to the point where you paid the same price for that higher risk, higher headache Class C as you did for Class A. And so it just didn't make sense to do it. And then when you get into a down cycle and cap rates expand, you get the most expansion in Class C. And that has happened. Cap rates haven't expanded nearly as much as any of us thought, but it has occurred. And so the most expansion has happened in Class C. And so now we're getting back to the point where you actually do get paid more for taking on that extra headache and extra risk in select properties. I think it's starting to make sense to do that again.
Yep. No, that makes sense. Now, I have more operational questions. I want to hear about where you're doing this and a number of other things along the lines of where you think those markets are headed. But you said something that I typed it on our note sheet here. For those people that just got started in the last 10 years, you said, just got started in the last 10 years. That's what I want to highlight because I think this is something, if I could I started 7 years ago. I bought my first couple properties in 2018. Got into the land and development space shortly after. And I wish somebody had put that in my head sooner to think about this on a multi-decade time horizon, as opposed to the go make a ton of money in a year and quit your job that's so often advertised on podcasts. And I think understanding that this is a long-term game and how far you can get in 10 or 20 years, I would have made better decisions and thought more strategically about how I was doing things and allocating my time and capital. Anything you'd like to say on that topic? Because I think there's a lot of other people like me that kind of learned about this via podcasts and had that, go get rich in a short amount of time and quit your job sort of mentality drilled in our heads.
Yeah, I mean, and the thing is that did work for a couple of years, near the peak. And I mean, as we know, that it all collapsed, but it worked for a while, until the music stopped. The cool thing about real estate and especially commercial real estate, is, it's not get rich quick, but it's probably the closest thing you can find to get rich for sure. And that's as long as you buy it right, you operate it right, and you finance it right, and have a long enough time frame so you're not up against a loan maturity, kind of like a financial gun to your head in 2 or 3 years, and now you have to make a decision in an adverse market. So it's definitely a long-term game. And when I say long-term, for us, our average hold right now is probably 7 years. The wealthiest people I have ever met in the real estate business are the ones who bought and never sold, or developed and just held on to it for 20 or 30 years. And again, that's another beautiful thing about real estate, is as long as you operate halfway decent and put the right financing on, time heals almost all wounds. You can make a lot of mistakes, but if you allow yourself the ability to hold for a long period of time, the odds are in your favor that the market will cover over those mistakes, to a certain extent, obviously. But and then also for those who are fearful or discouraged right now, be aware the next 10 years are going to be much harder than the last 10 years. Because the last 10 years we had abnormal tailwinds. We had, ZIRP, right? The zero interest rate period. That's not very likely to come back, and don't hope that it does, because if it does, that means we probably got bigger issues going on. We had the explosion of just the whole, kind of podcast, boot camp, syndicator environment that just brought in a ton of more buyers and attention and bidders. We had a very strong economy, growing jobs, growing population. I mean, basically almost every factor you could come up with that supports multifamily and commercial real estate in general was positive, and for an extremely long period of time. We're now kind of wrapping up a reset of that. And while for a variety of reasons, the fundamentals for multifamily look really good for especially, the next 5 to 10 years, I would say probably out until about the mid 2040s. It's not going to be like the last 10 years. This is going to be more of a normal environment where success is going to require good market selection, good property selection, good operations, proper debt structure, patience, true value add, right? Not just buying something, changing the paint color while the market goes up, and then reselling it and bumping rents $200. True value add is actually improving the property physically, taking it from one condition to another. So the good news about all that is it's going to keep the competition thinner. And so for those who are willing to put in the time, effort, and do the work, there's a lot of opportunity coming. Just don't have the expectation that's going to be like 2018, 2019, or 2020, where basically if you had the guts to buy almost anything, you made a lot of money.
Yeah, and I think that's one of the challenges is, while, the market has certain cycles and everything, some of those cycles might be 5-year or 10-year, and some might be a 50-year cycle. So what we experienced after the recession in 08, 09, going into the last decade to 15 years is significantly different than what we're experiencing right now. And for those of you guys that get information from podcasts, make sure you stay up to date with your information and don't go listen to a Bigger Pockets episode from 2015 and think it's going to apply to today. And Andrew, there's so much I want to pull out of there, but I do want to switch and pivot just for a moment into the tactical aspect of, obviously buying right and structuring the debt or structuring the financing of the deal is crucial in any deal in any market. 2024 for you, were you guys buying? And if so, can you share a little bit about what market, what the deal structure looked like?
Yeah, so 2024, I would describe largely as us trying to buy, with very little success. We actually did get a property under contract and closed it the day before Thanksgiving in 2024. That was the first thing we bought in 18 months. And we had looked at over 800 properties in order to get that one, because sellers were still looking back to 2022 saying, I want or need to get this pricing to get out of this deal. And as buyers, we're like, our debt is now 6.5% or 6.25% or whatever. We can't pay that anymore. And so, we're just the gap between seller and buyer expectations was huge. The one that we did buy in late 2024 actually ended up being an assumption. So that means we took over the seller's existing loan, which was at I want to say right around 4%. And then we got a supplemental. And so we got, so kind of adding a second onto that. And the property was in a market where it's a great suburb of Atlanta where we actually already had another property 3.5 miles down the street. And we had been chasing this property off market for 2 years, meaning one of the things we do is we'll pick a market that we really like, and we look at every asset in that market that fits our description of what we would like to own. And then we take that list to certain brokers and be like, hey, how many of these properties owners do you know? And would you be willing to submit an offer? And so we had submitted an offer to the owner of this property 2 years prior. And they're just like, nope. Every quarter we'd follow up, saying, nope, 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 nope. And then all of a sudden, they had some, let's say, challenges in other parts of their portfolios. And it's like, all right, if you can close quick, we'll do it. Because they needed to take the equity from this deal and move it to other deals, and so that's how we got it. It was just kind of, again, the long-term follow-up, patience, knowing exactly what we want. We've got very long-term broker relationships, so they know exactly what's a good fit for us, and we had the track record, and then also just we're already in that market. So yeah, again, it was off market, kind of basically sourced ourselves with brokers involved. A lot of people like to go around or talk down about the brokers. Candidly, I mean, the brokers spend their lives building these relationships, and they're really one of the best tools to grow your business. It's all about relationships here, and I would encourage those who, so I've met some people. I met one guy who's like, I don't trust any brokers. It's like, you're probably not going to do a whole lot in this business. But I digress. So we were able to assume their loan. So, one of the challenges with buying things right now is you underwrite a deal and then the 10-year treasury moves 50 basis points while you're under contract. And now your debt has completely changed and the deal doesn't work anymore. So when you're assuming a loan, that piece is already fixed. The loan balance and the interest rate. And then it was value add and all that. So that was the first deal that we had closed in 18 months. And again, it took looking at over 800 properties in order to get it. So it's been, the last couple of years have been very, very slow in terms of acquisitions.
Yeah. And it feels that way for a lot of people too. And I, can appreciate the simplicity of, you look at everything until you find something that works, and you're doing it in areas where you can, achieve economies of scale with property management, and you're very familiar with the market and the demographics and everything going on with it. But me being someone that is, while diligent, sometimes, you hear 800 deals before you get one. And those are numbers that we're used to. But had you ever thought about, during that period, while acquisitions was so difficult, of just putting new inventory on the market and going vertical? Because I've noticed that in your portfolio, it seems like almost all of them were built before 2000. Mm-hmm. There's a few that are newer, but had you ever thought of just building your own apartment complex?
Yeah, I think the average age of our portfolio it would probably work out to be right around 2000 or 2005 or something like that. But so the short answer is yes, we very much have looked at doing development. In fact, we in particular have looked at doing modular development, which is faster, less expensive, a little bit more reliable. There's some difficult challenges with it too, but and we've actually come close to a deal or two on that. We have not pulled the trigger, especially with a couple of acquisitions coming up. And then, during that period where it was really difficult to find a new acquisition, we took that time to really focus in on trying to improve operations and asset management. And so, we said, hey, this is an opportunity. We're probably not doing it. It looks like we're not going to be buying anything for a while if this continues. So, we hired some more team members, and again, really dialed in asset management. Now we are shifting more back towards a focus on acquisitions. And in terms of ground up development, I would say that anybody who's attempting to do that or can do that, I do think it's a really good time to do it. Because yes, we've got a ton of deliveries right now, but that is falling off a cliff. And if you start a project today that delivers 2 years from now in 2027, you're not going to have a whole lot of competition, and you're probably going to be delivering those units into an environment of very high occupancy and very strong rent growth. So, for us, we are not actively doing ground up development, but do I think it's a good idea in the right markets right now? Absolutely. What we are doing is number one is, like I said, we actually do have some acquisitions going now. That kind of takes the pressure off to say, well, let's look at development. And then second, kind of along the same lines, is we are in the process of vertically integrating renovation, meaning we're putting together our own in-house renovation team so that we can get renovations done more cheaply, have better control over the timing, have better control over the quality. And that can be really significant savings, not only like savings for existing investors, but then also when we're underwriting deals, we can be more competitive. I'll give you an example. The one that we're getting ready to close here soon has a $3.4 million renovation budget. Well, if we can cut 20% off of that, then you're talking about a savings of $680,000. Which in a case of a property that we already own, that's just savings or capital that can be either deployed to other projects or given back to investors. Or even bigger picture going forward, once we are confident that we can do that, then if I'm bidding against another guy, then that means I can technically pay another $600,000 and still hit the same returns because I'm that much more efficient on a renovation. So that's our current focus. But if the right development opportunity, came along, would we look at it? Absolutely, because I really think that's a good opportunity for those who can make it work right now.
Yeah, that makes sense. I personally built a duplex last year and kept it, and it's a great little rental property. Obviously, very, very small scale, but it's nice not to have any repairs for a while. So, Andrew, something I want to talk about is market selection. You mentioned Atlanta. What other parts of the country are you in?
So we focus on the Southeast. So North Florida, Georgia, Carolinas, Eastern Tennessee, Southeast Virginia, and a couple of select submarkets in Alabama.
Okay. So I always like to ask people in your space, especially about red versus blue states. And, to your point earlier about contrarian thinking, it's an interesting dichotomy where the red states make it a bit easier to bring on inventory, easier to evict people, more friendly to the landlords. But then, of course, that draws more people to them. Whereas I'm not sure if you're still in Southern California, but when I look around here, San Diego or LA or where you at?
Right on the Orange County, LA County border. So just north of Disneyland.
Got it. Okay. So you're a little north of me. And I look around at the people who own a lot of multifamily here in San Diego who have put the systems and processes in place to handle the ridiculous laws, and they are doing phenomenally well. They get crazy returns oftentimes because they figured out how to put up with the laws here, whereas so many other people won't do it. Do you have any thoughts around that? Do you ever consider moving into markets like Southern California?
So my philosophy is live where you enjoy living and invest where the returns are the best, right? And people ask me all the time, like, well, you could live anywhere. Why do you live in California? And I'm like, well, first of all, that's where my house is. And then second, I love, to surf and ski and do all those things. Blue versus red state, I live in one of the darkest blue states, and then we invest in the darkest red states. That is a business decision based on what you said is I want to operate where it's basically landlord tenant balanced or maybe even landlord friendly, where they're business friendly, where the tax laws are a little bit less aggressive, and it's just easier to operate. Cost of living is cheaper there. And our business model focuses on a blend of cash flow and appreciation. And that is part of why we like the Southeast, is because you can get appreciation, but also have cash flow along the way while you're on the way to achieving that appreciation. So, you know, in the last cycle, I mentioned this earlier, we sold properties for 4 and 5 times what we paid for them. Like, that's significant appreciation. And part of it was, like I said, that was an abnormal cycle. But that's one business model. The other business model is what you talked about, Dan, of, hey, I'm going to figure out how to operate in this very difficult California landlord market, where I'm going to I have very high, what I like to call legislative risk, right? You never know what new law they're going to pass that's going to try to screw you over as a landlord or property owner. So you have significant legislative risk. It's without putting down massive amounts of equity, it's extremely unlikely you're going to have anything remotely close to positive cash flow for the first couple of years. But if you can figure out and solve those challenges, your appreciation potential is through the roof, right? And just like you said, like I'll get on a podcast and say there's no way in heck I would invest in California, and that has been true for the last 15 years, and it'll continue to be true. But that doesn't mean you can't make a lot of money doing it. There's a whole lot of rich people in California that made their money in real estate. It's just you have to decide what type of operating environment and business model fits your risk tolerance and your preferences. Now, with that said, I have some friends who have lots of units in LA who are getting crushed because, during COVID, LA had like a 2-year eviction moratorium. And so nobody paid for 2 years, and then the owners couldn't get them out. And then very strict rent control. And they actually just a couple of weeks ago, they just passed something else that was just, I can't even remember what it was. It was absolutely crazy. I'm like, oh my gosh, I'm so glad we don't own anything in LA. So yeah, it's a very different environment. But again, if you can solve for it, typically the harder something is to do, the more money that can be made in it. Right. Because guys like me are like, I ain't dealing with that headache. I want to be able to, do our thing in the Southeast, get some good properties, make good returns, and still be able to, not be so stressed out I can't surf and ski on occasion. So.
Yeah, fair enough. Totally a personal opinion. There's no right or wrong answer. I was just curious how you think about it. When I lived in Colorado, I moved there in 2018, and I remember seeing how the laws around both building and tenant management were getting more and more blue, and I kind of chuckled, and I thought, great, it'll make sure to push up prices and constrain inventory and make sure that both rents and values go up. So, of course, Colorado is nothing like LA, but it's headed in that direction. So this is something I think about for the long term with a lot of my buy and holds there. So anyways, yeah, that was more just, I wanted your opinion more than anything on that.
But so Andrew,
go ahead.
I want to talk a little bit about your team structure and some of the ideas that have gone into the way you've been growing your team and potentially doing some vertical integration during the past few years. A lot of people feel that it's really difficult to hire more staff or spend more money on marketing and, to get acquisitions, especially whenever, new deals aren't flowing and, things might not be as stable as they could be. So could you talk about the decision behind, not necessarily the vertical integration with being able to do your own renovations, but you said you added more members to the team and you've beefed up staffing. Can you talk about the org structure and then the mindset around that during this time?
Yeah, so the kind of the structure of how things sit today is we have there's myself, I'm the founder and main principal. And then we have 2 people on the leadership team. One basically oversees asset management and the other oversees acquisitions. And then there's a handful of other folks that, that work with them. And then of course we have a virtual assistant in the Philippines as well. Our core team is 7 of us. if you include everybody from investor relations to asset management and acquisitions and all that. But that's because we use third-party property management. So and actually, we have a hybrid management model where we've actually partnered with the same third-party property management company since 2011. And basically how we look at it is like, we don't want to deal with, okay, the lady in 6A, her dog bit the guy in 5B, and now there's an incident report and filing evictions and payroll and collections. And we don't want to deal with that day-to-day stuff. But at the same time, one of the best ways to have your property fail is to buy it, hand it over to third-party property management and say, send me the report at the end of the month. So we do a hybrid model where, we approve, for example, any and all hires at the property, like property manager, the maintenance. We're doing the final interviews. We do weekly calls with our asset manager where, everybody from the onset on who works at the property, the people, the relevant people from the management company are on that call. And, we have an agenda every week so that if you go to a property and if you were to go to, Ashley Oaks and Carrollton and be like, hey, Holly, who do you work for? She's going to go, oh, Andrew and Kelly, and technically she works for the management company, but most of them, if you ask them, oh, they work for us, right? Because we are very deeply involved in making sure that our number one role is to support them. Like that's a question we try to ask our managers and maintenance people all the time is like, how can we make your job more effective and or easier? Are there tools that you need? Is there software that you need? Are there administrative hurdles within, the management company that we can try to solve? That's our number one goal. And then, we're there to provide the vision, the big picture, like, okay, we need to make sure we get through these many, renovations, etc. And so we do a hybrid model where we're deeply embedded within the management. Now, some management companies can't handle that and won't do that. So if you're going to do something like that, you need to have the right one. So getting back, so that's what our core team is just 7. And, in terms of how we got there, we were very careful that we didn't overhire based on our ability to support. So anytime we bring someone on, we basically want to say, you don't ever have to worry about losing your job because of a financial situation. So we brought people on as our cash flow and income allowed us to. So that especially the last few years when people were doing the opposite and starting to downsize and tighten up, one of the great things about a recession or tough times is it gets easier to find really good people. And that was really hard 5 years ago. Whereas now it's a little bit easier. And so that's kind of our philosophy is we in a sense, hiring people on the P&L, it is an expense. And so in that sense, you've got to make sure that that's covered, both so you don't run out of cash and so that you're, doing the right thing and not bringing somebody on. And then a few months later going, oh, sorry, I made a mistake. I can't afford you, right? Because you're messing with people's lives if you do that kind of thing. But so in one sense, it is an expense on the P&L. It's one of your biggest expenses. However, we look at it as a long-term investment. If I could go back and do things differently, one of the two things I would do, or if I was giving advice to my earlier self, it would be to bring in talented people much earlier than I did. And again, you might be, if someone's listening, well, that's great, Andrew. I don't have the money to pay salaries and all that. There's alternate ways to do it. Number one, you can give people equity. You got to be careful of that because you can end up with this big company and no ownership down the road. But you know what? That's what a lot of people do to get started. I did that to some degree. And then you can do, especially if you have a little bit of experience, you can do like unpaid internships. You can do partnerships. So it doesn't have to be go out and I've got to afford to pay someone 120 grand or whatever. There's all kinds of other ways to do that. And then also, and I know this goes a little counter what I just said, but in terms of getting yourself over that hump, it's not okay, I'm hiring someone, there goes 120 grand. Typically you pay someone bi-weekly, right? So in a sense, if they don't work out, let's say, then 90 days later, hey, this isn't working out, right? So and if you bring on the right people, you're going to generate that much more value and income, and hopefully a multiple of what you're spending. So that's kind of our philosophy on hiring and building a team. And don't rush it. Just be absolutely certain as much as possible you're bringing on the right people.
Yeah, a lot of great points on there. And I think one of the main ones is as you're looking to grow and expand, it's not an annual cost that you incur immediately with any employee. Make sure you're hiring the right people that are in the right roles, obviously. And if you're bringing on a salesperson with a small base, it could be very small chunk of change that you're putting in there, and if they're not adding value within 60 to 90 days, then obviously terminate them. But Andrew, during the hiring process, how do you make sure both the people that are directly in the organization, like those 7 people, as well as people that are a little bit outside for the property management company, are totally aligned with the mission and values that your organization has, as well as aligned financially with the goals of the organization?
Well, to start with, no matter how good you are or think you are, you're never going to perfectly be able to do that. I think if you have a 50% success rate, you're crushing it. Because you can only tell so much through interviews and all that kind of stuff, and then sometimes communication just doesn't work, or people have ulterior motives, or for whatever reason. So number one, I'd tell her, don't be frustrated if you don't get it right the first couple of times, because almost nobody does. How we try to ensure alignment is we have a very, very thorough, kind of lengthy process. And that actually turns a lot of people off, which is perfect, because we don't want the tire kickers. We don't want people who are kind of interested, or, well, maybe this is a good option. So, like, let's say we have a position open up, and we'll post it. I'll talk about it on podcasts. We have recruiters that we go out and actively try to find people. So that creates a certain pool of applicants. The first round involves the usual send a resume and all that, but also some things, usually 5, 6, or 7 different things. One of which will be complete a disc profile, which is one of the personality tests that are available out there. It kind of just gives an indication of communication style and work styles, all that. Have to complete that. Send us a 120-second video, and usually the subject line is why you think you're the best fit for this role. And then we will pick some tasks that are relevant to the role. So let's say you're hiring an analyst. We might send them a 12-month P&L from a property, and ask 5 or 6 questions about it, and see how well that they can answer those questions. And then some tasks will be very specific, where we're testing for an ability to follow detail and instructions, and some tasks will be intentionally vague. And what I found is some of our best additions to the team were the people who can take a vague task and say, you know what, I have no idea how to do this, but I'm going to make my best guess, and then I'm going to provide my reasoning so that it's evident how I got here. We've actually found that to be very, very revealing, because ideally you want somebody who, once they learn the role, learn the position, will go out and solve things on their own. You don't want someone who's just going to bring every problem to you, because now that doesn't really help. So that's part one. And then when we get into interviews, we have multiple levels of interviews, where we're actually not really focusing on skills. Skills can be learned, skills can be trained. Character can't be. That is inherent in the person. Character and values aren't something that we can really impart onto somebody. And so our interview process is actually very heavily focused on those aspects of what is somebody's character, what are their values, goal alignment. I mean, someone could actually be a stellar person in all regards, but their goals are different from our goals. So it's just not a good match. Doesn't mean, I mean, again, they could be one of the best team members out there, but for another organization, just because like their desires don't match what we're doing. And so that's another thing that I found is really, really critical and leads to a lot of success in hiring is goal alignment. Like I said, we do multifamily in the Southeast US. We wouldn't be a good fit for someone who wants the excitement of high rises in New York or LA. Right? It's just, they could be more talented than any single other person on our team, but it just wouldn't be a good fit. So so we actually focus less on skills that can be learned later and much more on goal alignment, character, and all those kind of things.
So, Andrew, one thing we haven't really hit on that I think is almost always lost on these podcasts is tenants and the fact that there are customers, right? When I was in high school, I managed rental properties for my boss. I managed a farm and I would manage his rental properties. And he had such a bad relationship with his tenants, and it was very vindictive. And then, of course, they caused problems and back and forth, back and forth. It was miserable, and I was always in the middle of it. And so one thing I've tried to do and reinforce in the property managers I have for just my personal rentals is these are our customers. We got to take care of them. And I have found that doing that, even if you are totally selfish and unconcerned with the people, it still pays off because the difference in how these people take care of the units, leave the units, just from maintenance requests, how everything goes, it's a much smoother dynamic than what I experienced when I worked for that guy as a teenager. So can you speak at all to how operators should be managing their tenants and really just providing a better product and service to their customers, and ultimately what that does in terms of yield and pain in the butt factor?
Yeah, that's a really good point, and you're right. That doesn't get talked about a lot. And actually, one of my biggest pet peeves that I see landlords do on social media, it's just been a trend lately, is the first few days of the month, you see the pictures of the T-shirts and the ball caps that says rents due. Like it's like your residents know that, and don't see them as an ATM that you just you go hit it the first couple of days of every month. Yeah, well, I mean, without your tenants, without your residents, none of this works. And the better you serve them, not only the better your property is going to run, and the less headaches you're going to have, and the more profitable you're going to be. You're just doing the right thing. It's easy. It's easy to be like, oh, I've got a duplex in LA, or I've got 4,000 units over here, or whatever. Especially on the investment landlord side, it's very easy for us to just think about it in terms of properties and P&Ls. And, I joke all the time. I'm like, as a 5-year-old, my favorite game was to play Monopoly with my grandfather. Right. And I'm like, I grew up to play real life Monopoly. I deal in big red hotels all the time. And it's easy to forget that every one of those little units is either an individual or a family's livelihood, right? I mean, these are homes. People are living there, they're sleeping there, they spend, probably most of their waking hours there. And, how you treat them, how you maintain their environment has a huge impact on their lives. And I think that's something that kind of gets lost as in the landlord mentality and environment. And, we're all talking about, we're going to try to make these returns, and that's all good and fine. Yeah. We're not in it to lose money, but, focusing on that, these are real people, these are real families. And doing that again, it's number one, it's the right thing, but like I said, it will lead to better returns anyways. And it goes as simple little things like just making sure that your maintenance guy, for example, whether you've got a duplex, and that's the only thing you own. Well, is the handyman that you send over there to fix things, does he greet the tenants nicely? Does he offer to take his shoes off? Does he get the thing fixed properly, and then follow up to make sure that it's satisfactory. And then again, if you've got a couple thousand units, like, so for us, we only buy properties, that are minimum about 100 units, because we like to make sure that we can hire somebody full time to focus on just that property. So when we're interviewing for maintenance supervisors, yes, we want them to be good at air conditioning repairs and all these other things. But one of the bigger things we're looking at is like, well, what's their demeanor like? How are they friendly enough to build relationships for the residents? Do they actually care about servicing the resident well? And if one property that we bought recently, the maintenance supervisor, the residents love the guy. In fact, probably the biggest challenge with him is he's so talkative that he's like, "Hey man, we gotta wrap this up and keep going, right?" But we joke with it, and he knows it. But he's talented, but the thing is where that shows up is, again, number one, you're just creating a better community, but two, people won't leave. People stay. It decreases your turnover. It decreases your vacancy. So yeah, there's a lot of customers in this business. Number one is your residents. Number two, if you're starting to scale, are your team members. If you're bringing in outside money, now you've got investors that are customers. And so, but at the root, at the base of it all, if you don't treat those residents right, it's just not going to work.
Yeah, I'm think that was very well said, and I'm glad you mentioned turnover. Again, thinking to so many Bigger Pockets episodes and various podcasts I listened to when I was getting started, I think that's underemphasized how expensive turnover is, and how having a good tenant that pays the bill, that takes care of the property, and stays for the long term is so essential to whether the asset performs well or not. A decent deal with exceptional tenants tends to do a lot better than a great deal with terrible tenants, right? Or even mediocre tenants. And I don't think that's talked about enough. But one more thing that I really wanted to ask, because you alluded to this earlier, you said the wealthiest people never sell. And I know something that Mason and I definitely are constantly kind of debating and trying to figure out for ourselves is, we each have our land business, which is our way of making money. And then we put money to investments. Mason's more in stocks than I am, and I have a couple dozen rental units, and I'm always conflicted on when to take money out of the land business and buy more long-term buy and holds versus just keeping it scaling the capital in the land business, and each has its pros and cons. So for you, where you do the syndication model, do you have any sort of personal investing you do where you buy maybe units you just keep yourself or anything like that? How do you think about that?
Yeah, and that's another one of those where it very much depends on where you are. So, before I got into multifamily in 2010, previous to that, we were flipping houses here in California, which California is a great place to flip houses, by the way, because you're not being a landlord, and there's lots of equity and big margins. But it was just what you said, is like, hey, every time we flipped a house and made money, like that money got reinvested back into the business because we had to grow the business. At this point, we're kind of at the transition where a significant portion goes back into the business, both for covering expenses like hiring, etc. Also, we invest in every syndication we do, we invest in that syndication, as in addition to the LPs. But then, yes, we also have some smaller properties on the side that do not have any other investors in them and are not syndicated, for that very reason. And, one of my long-term personal goals is the type of assets that we are now buying with investors, 130 unit property built in 2010 in a good market. One of my goals personally is to buy something like that without investors so that I can sit on it for 20 or 30 years. Right. Now, there are investors out there who want that long-term horizon. But I remember the first time for our very first deal, I went to a long-term financial partner, the guy who'd been funding most of my flips. I was like, hey, I'm doing this new thing. It's a 5-year hold. Here's the returns, et cetera. He looked at me, he goes, that looks great. He goes, except I might be dead in 5 years. And I'm like, dude, first of all, you need to be a little more optimistic. and then like in 5 years is going to go by like that, right? Like it's a lot quicker than you think. So if you're bringing in investors and doing a syndication model, that's part of why you tend to see a lot of deals with 3 to 7 year time frames, is because understandably people want to know, hey, I'm going to get my money back and go use it. And there's alternatives to that, right? We have some properties that we're now on year 9 because all the money's already out and they're doing really well and no one wants to sell. So there are different ways to do that, but yeah, I would like to get to the point where we have some properties where we can sit on them for 20, 30 years and just get to that point. So that is actually the end goal. And again, you can do that with a duplex all the way up to 200 units. So
Yep, absolutely. And we're firm believers of figure out how to make money and then invest that and hold it for as long as possible. It's really tempting sometimes, especially, in markets like, I didn't have anything then, but in 2020, 2021, whenever things blew up, I'm sure it was a great opportunity for people to sell off. And then if people made it through, appreciation continued. So one more quick question before we move to the end of the show, Andrew. Dan and I were just at the International Builders Show in Vegas a couple weeks ago, and it was fun interacting with people that operate at a corporate institutional, really, really high level, multiple hundreds of millions, billions of dollars in deals. And then we also hang out at local real estate meetups where people maybe have 1 or 2 rental properties and, or have listened to 40,000 episodes of podcasts and know more than we do and have read every book and spent 50,000 on education, but don't own a property. Where do you hang out with? Who do you network it with that, what environments do you create around you that you feel like elevates you and also challenges you, but isn't distracting or meaningless?
yeah, that's a really important thing to consider. So I'm naturally inclined to be a homebody. I like to spend time at home with the wife, kids, and cats, or deep in the mountains, skiing with like just 1 or 2 friends. So I have to push myself to network, and because this is a relationship business. I mean, without relationships, you're not going to do a whole lot. So my primary source of relationships and networking is I'm in a mastermind called GoBundance, and I won't get into all the details of it, but there's requirements to be able to join, and so it's a large group of successful individuals. A large percentage of them are in real estate, but then there's quite a few that are in all other aspects. And so what I found is there is yet to be a single question about business, finance, even health and fitness, all these things that I can't pose to that group, and 10 other people have already solved it. And because the culture of the group is, hey, it's a mindset of abundance. That's where the name comes from, right? Go with abundance. It's a mindset of, a lot of times you get into situations where like, well, I don't want to tell you my secrets because then you're going to become my competitor. Well, the mindset in abundance is the opposite of like, no, relative to any one individual, there's an infinite amount of money out there, right? I mean, our 34 trillion, what is our national debt? 34, 37 trillion, right? Think about it. Compared to any one individual, effectively, that is infinite. And that's just our one country's debt. And so the mindset is there's more than enough for everybody. And let's just let everybody help the other guy get up the ladder, right? And so that is my number one source. And at this point, I think there's like 800 members. So of networking and connection. And then, there are a handful of other conferences that I go to. I go to some IMN conferences. And then, I've been to Best Ever. I've been to Bigger Pockets. And then candidly, the outside of abundance, probably the second best source of like networking and relationships is organic masterminds, right? So that's another thing. Like abundance has an annual fee, and a lot of these masterminds do. And especially if you're getting started, you mean like, well, I can't or don't want to afford to pay that. Okay, fine. Again, but it's like I'm in 2 masterminds that I absolutely love. They're extremely valuable. The annual fee is 0 because it was an organic group of us that over time kind of met each other at these different conferences or different places and said, hey, it might be valuable. How about once a month we just do a call and we go through what's working for us and what kind of challenges we're facing. And so that so there's two of them. That once a month for an hour and a half we do a Zoom call, and that's part of how I stay relevant with, again, relationships, knowing what's going on in the market, what other operators are struggling with, how they're solving those things. How can I help them? How can they help me? So, for me, it's a mix of paid masterminds, industry events, and just organic groups that have kind of come together over time.
Yeah, that's a perfect answer right there, and I think we could spend a lot of time chatting about it, but we want to be mindful of time. But I think the one thing I do want to say about it is sometimes you have to pay to play. You have to pay to get into the right rooms and network with the right people or go to the right conferences. There's a lot of money going behind it. A lot of these groups aren't just making a ton of money hosting these events and doing these things. It goes back into the members, and then the members are doing deals together and all that kind of stuff. But two, just if you have a group of like-minded people with similar vision, values, and have different temperaments, talents, and convictions, you can create something really, really beautiful together, just hopping on a Zoom call once a month. But Andrew, I know we've already gone over time. Thank you for being so generous. But before we go, one question we do like to ask all our guests is, were there any questions that we did not ask you that we should have asked you?
Do we have another hour or no? There's a lot of things. A question that you did that you should have. Man.
Understanding it's a 1 hour show, 1 hour-ish show.
Yeah, I guess I would just say is, maybe say, all right, Andrew, what would you recommend the most important thing is, for someone going forward, in either getting started or looking to scale in this next cycle? And I mentioned this before, is it's buy it properly, put the right debt on it, and then operate it well. And that gets into, number one, knowing what fits your business model and your what you're trying to do. So are you going a blue state or a red state? Are you looking for fourplexes or 400 units? Are you going to hold for 3 years or 10? Because that changes the kind of debt you might put on there. Just you have really clear, specific criteria for what your goals are, what you're trying to do, and then use those criteria to develop the exact criteria for the kind of properties that fit that, and then go out and network and connect and partner with the right people to make that happen. Again, it's not going to be as easy as the last 10 years, but we are staring down some really good opportunities coming in here again.
Agreed. Yeah. So clarity is, yeah, exactly. So, all right, Andrew, where can people find out more about you?
I'm not a social media guy. Probably the only thing I post on Facebook or anything like that is an occasional surfing or skiing photo. So there's really two ways to get in touch with me. Number one, our website, just Google Vantage Point Acquisitions. It comes up, but it's vpacq.com. There's a connect with us tab on there somewhere. And then I actually do post twice a week-ish on LinkedIn. And so, yeah, I'd love to connect on there, because if you comment, that actually is me. That is me posting, and that is me commenting. It's not a team member. It's not AI. So I like to have real conversations with people on LinkedIn. So
awesome. Well, Andrew, thank you very much for your time. Everybody, this is Dan Haberkost and Mason McDonald with Andrew Cushman signing off for the Big Picture Blueprint.